Hi, I'm Vishnu Srinivas, and welcome to Hawkeye, a podcast featuring prominent business professionals and their views on topics impacting businesses and economies around the world. Make sure you rate, review, and subscribe. Joining me today is Karthik Sankaran. He is a market strategist at Corpay. Thanks so much for taking the time to speak with me today.
Thanks very much for having me on.
Awesome. So do you want to start off with a short introduction about your background and your role?
Sure. Right now, I'm senior market strategist at Corpay, which is a leading provider of cross-border payment services for companies. So so it involves basically a lot of foreign exchange, and so essentially I help out the foreign exchange strategy team there. And foreign exchange is what I've been doing in one form or another for for almost 25 years. Yeah. I entered the market almost exactly 25 years ago, 2 weeks before the Thai baht crisis started. So in 1997. So kind of been very involved with foreign exchange and with emerging markets in one form or another. Before that, actually, I kind of had a checkered career getting into finance. I was an aspiring historian. I almost finished a dissertation in 19th century Italian history. And somewhere along the way, I came to the conclusion, justifiably, that I would have no control over where I worked, because the only way you get a job in 19th century Italian history, if you're lucky enough to find one at all, is if the person holding that slot has either retired or unfortunately passed away. So there's really not a lot of control that I want to stay in New York.
Yeah.
So I kind of bluffed my way into kind of finance adjacent journalism, first doing conferences in Eastern Europe right after the Berlin Wall had fallen in the early 1990s, 1994, 95, conferences for foreign direct investors. Then I was a journalist working at the publication that specialized in the IMF, World Bank, and the National Development Banks, called Emerging Markets. And from there, I wanted to start a magazine, tried to speak to a backer who said, that's the dumbest idea I ever heard, come work for me instead. And I was hired as a research editor for an FX trading firm. And within 2 weeks, the baht crisis started. And the guys on the emerging markets desk said, this person must know something about politics, and politics is important now. So I went and sat with them on the trading desk while continued to edit, research. I had the incredible good fortune to work for a very brilliant economist who needed editing, though. That was my job, was to kind of digest everything that he said in kind of sound bites for the, for the traders, for our customers. And that was fantastic because I learned a huge amount of kind of open economy, macroeconomics, and its implications of foreign exchange in the context of sitting on a trading desk during the rolling emerging markets crisis from 1997 to 2002, the launch of the euro. So it was a fantastic, fantastic education. Got really lucky. Kind of stayed on the sell side for a little while, went to a global macro hedge fund, was there for 8 years. And most recent, then after that, decided I wanted to change of pace, went to a geopolitical risk consultancy, where I kind of draw back on the history and politics side of my background, and now I'm at Corpay. So I've had a chance to learn new things and stay in touch with old things. So that's all been good.
Definitely. And it's a really interesting background that you started out in European history. And I'm wondering, how do you think that background there really helped shape your outlook, your future outlook, working in global macro?
I mean, I'd say two separate things. One is that, a part of it is, this is, I'm not sure, who your viewers are, but to the extent that there are people kind of in university and thinking about how to structure a resume. You know, I
plenty of those people listening.
Yeah, yeah. So it was funny because I had this incredibly obscure dissertation topic, which I got 9/10 of the way through. It was about lawyers in a small town in southern Italy and their political role in the late 19th century, which is I have a published journal article about that subject, which I think maybe 3 people have read in the entire world. But in the course of thinking about how I could parlay that into something that actually seemed useful to a future employer, and with some degree of honesty in terms of how I came to think about that, I said, my specialization is the political economy of development, which, when I thought about, maybe not what I had written, but all the background reading I had done, it was really, useful in that template for thinking about emerging markets, for thinking about the interactions of politics and economics, for thinking about what makes for successful catch-up growth, what makes for backwardness. That was really helpful, kind of over the long term. The second was Europe itself. And I'd say that, we've had the euro drop below parity, recently for the first time in 20 years. And thinking about Europe through the context of a European history background, about European unification, its pitfalls, that was also a really big part of what I thought was useful, particularly in this, because the person I worked for, the institution I worked for, was extremely Eurosceptic, extremely pessimistic about the prospects for the euro survival, which is a belief that I imbibed, and I say that basically from 1999 to 2010, I thought the euro was going to blow up. And then on the second half of the euro's existence, I've become much more optimistic about its prospects for survival. It doesn't have much to do with what it does on a day-to-day basis, but that's also kind of informed by my understanding, what I think is my understanding of European history, the incentives for the major European powers, and so on. I think the third thing that what the history does is I'm just interested in reading about policymakers and what they think, what they do. And one of the books that I keep pushing all the time as a great resource for people who kind of in macro or in foreign exchange is a book called The Confidence Game by Steve Solomon, which is basically a history, a journalistic history in incredible detail of the international monetary and financial system, goes from like 1973 to the early 1990s. And he's got a spectacular set of interviews. So you kind of get into the heads of James Baker, there's all these people who are making monetary policy and exchange rate policy and fiscal policy in that period, dealing with the third world debt crises. Yeah. And so I think it just helps to understand what those guys were thinking, what background they bring. And if I may permit, one anecdote that's actually kind of market relevant in this regard, I think, and this is kind of a history of a history in the sense that I honestly believe that one of the, there was this question on Twitter, what can you think of any instance where historians have had a major impact on the world, like actually practicing historians? Mm-hmm. And typically the answers were historians, but I thought to myself, one example is Ben Bernanke studied the Great Depression, mm-hmm. knew that US nominal GDP fell 40%. You think of the Great Depression as being a 25% fall in GDP, but that's real. It was 40% nominal, which is staggering. Yeah. And his reading of that feeds into his advice given to the Japanese in the late 1990s, and then back into how he responds to 2008. And I remember kind of at some point in 2010, going back and reading the advice he had given the Japanese and thinking, okay, there's going to be more QE coming down the pike, because what you kind of knew from what he had, and this is someone who had imbibed this huge history of everything that happened during the Great Depression, everything that went wrong, how to fix it, and what the Japanese should do in response, and kind of made sense that he would have a similar response when he himself was in charge.
Right.
Which then actually became something that was a market mover. Anyway, it was long-winded, but
yeah, definitely. I think, having this backbone of history and this knowledge, such a deep knowledge, really gives you a unique framework to kind of look at so many of the solutions of the problems that are that countries face today, and help craft policy solutions for them. And going to my next question, like obviously in your time as a macro strategist, I'm curious, there must have been a lot of different challenges and lessons you learned along the way. Could you speak to some of those?
sure. It's been a while since I was involved, kind of in the guts of a strategy per se on a risk-taking basis. But yeah, I'd say, the big things that you kind of learn fairly early on, especially kind of making the transition from, early on, it's just like, oh, I write this, I think this. But then very early on, you learn the discipline. It's not enough to have a direction, you need to have a time.
Right. Yeah.
It's not enough to say this is going to happen because this is, over or undervalued. You need to say, okay, this is going to happen within this time frame. You need to think about possible signposts that either buttress your view or that make your view wrong.
Mm-hmm.
And that's kind of a discipline that kind of is different from, being a journalist or something like that, or a advisor who's more distant from price. So timing is important. I think the second thing that you kind of learn when you're in the trenches, as it were, is not just timing. It's not just signals. It's like watching the headlines. It's getting the pulse. It's getting the pulse of the market. But it is also thinking about what is already in the price, and that's particularly true in the case of political risk, right? Because we have benchmarks to know what's in the price for the Fed meeting or the ECB meeting or something like that, because they're financial instruments that will tell you what's priced. You have consensus, you have economist polls, and you have market pricing. So you can have a clearer sense, not just of where your view fits or diverges from consensus qualitatively, but also quantitatively, and what the potential impact of that is. That's not true for other kinds of market drivers, political ones and geopolitical ones. So that's more of an art than a science, but anything that you can do to make that view more scientific, or in a sense, or at least more rigorous, is something else that I've learned over the course of time. You have to do that.
Yeah, and I think those lessons are really invaluable, especially when we try to look at some of the current events that are happening today, which is kind of where I want to head next. Because shifting to emerging markets, we've been seeing a lot in the news about current turmoils in a lot of different countries, namely Sri Lanka. And I guess, do you think the drivers behind these current problems they're facing carry any weight to other emerging markets?
Yeah, they definitely do. I'd say at this point, it's not necessarily the big systemic ones, but there are certainly lots of other places that have troubles that are similar to those in Sri Lanka. Hemorrhaging of reserves, facing a very nasty inflationary shock, having a large stock of having a large stock of external debt. So it's it's kind of your classic situation where you have typically seen external creditors get involved, having to tender concessional assistance in return for conditionality. Then you ask the question of, well, what is the politics of whether or not the conditionality will be acceptable, which is where, which is a big part of at least the intellectual background that I brought from history and journalism into my, into the Asian crisis, and then again at the geopolitics consultancy. So all this stuff, there's a, there are commonalities. One of the, but as I said, it's going to be, my sense at this point is that these issues are going to be potentially widespread in terms of number of countries, not necessarily in terms of global GDP weight.
Yeah, I think it's a good way to put it. And in that kind of same context, do you think that should make us wary of these other emerging markets because, of rising debt levels we're seeing and possibly likely defaults on those?
I think this is where I think you have to differentiate across emerging markets. One of the things I've become increasingly convinced of in recent years is that emerging markets is not a, it's a grab all bag of countries, basically. And there are enormous differences across countries, and there are even enormous differences across broad asset classes that seem to contain emerging markets, because different emerging markets asset classes have different kinds of countries in them. And my broad, the way I think about it is that the broad distinction you want to think about with emerging markets is what is the likelihood that they will become less emerging over time, that they will converge, right? So I have a pretty hardcore view on what makes an emerging market converge. And that is basically technological convergence. And, Ricardo Hausmann has this idea of economic complexity, which is being able to do a large number of things in the global economy well that other countries, that a relatively small other number of countries do, is kind of one way to think about this idea of complexity. And I think any country that is making that transition or those transitions alongside technological complexity is becoming a less emerging market. It's converging. So that's one way of defining. Another way of thinking about it is, from a more financial point of view, is what is the ability of a country to do countercyclical fiscal or monetary policy when faced with a slowdown. The way I define it, a developed market is a country that can do those things. An emerging market is a country that cannot do those things, or that may find it much more difficult to do those things. Which in turn comes back to the question, why is it that you can do these things? It's because you have a larger stock of debt denominated in your own currency. You do not have a high propensity to capital flight. You have relatively limited exchange rate pass through into either your inflation or your inflation expectations from having a weak currency. So you can cut rates, you can have a weak currency. There are all these different things that intuitively and analytically we know developed markets can do, and emerging markets typically find it much harder to do. So I'd say that's kind of on the financial side. One's on the technological side. You'll notice that, I think another point I would make here is, state capacity and social cohesion. Typically, these go alongside the other attributes, but that's something else that emerging markets have that other emerging markets don't have, or developed markets do have, but other countries don't. So the other thing is, all of these I would place on a spectrum. Now, so kind of your ideal type then of a developed market is a country that has very high levels of sovereignty, of financial sovereignty, in the sense that's able to respond countercyclically to a shock, both through fiscal policy and through monetary policy. It is a country that is economically complex, so it has, it has multiple points of engagement with the international economy, not just one sector. It has the ability to collect taxes. It has low propensity to elite capital flight, and you can kind of see some countries will have none of these attributes. Some countries will have all of these attributes, and some countries, the really interesting ones, will fall in the middle. Right?
Yes. So yeah, I think that's a great way to put it. And speaking of these degrees of freedom with which policymakers can kind of shape how they're going to solve an issue, especially in talking about developed and emerging markets, this kind of leads into a question from Macromaniac, who wants to know, what are the degrees of freedom left with the Federal Reserve and the European Central Bank after exhausting rates and balance sheet in the inflation era?
Well, I mean, I think if you have it depends on the shock we're facing, right? I mean, they've exhausted, you could say that they have exhausted rate cuts and exhausted balance sheet expansion, which I'm honestly not even sure that's true, to deal with a disinflationary shock. But that's not the shock that we're facing right now. If anything, what we're facing kind of goes in the opposite direction. So you get a different kind of question at this point in the cycle, which is, what is the capacity to deal with an inflationary shock by raising rates and or reducing balance sheet without causing untoward financial disturbance in the economy, right? So, so to me, so it's not so much that each set of tools has been exhausted. The question we're asking now is, what is the ability to reverse those tools, to use them in the opposite direction without causing financial distress?
Right.
And to the extent that you don't use those tools, are you subject to, what's called, this idea of financial dominance, that policy is constrained not just by what, that monetary policy is constrained not just by concerns about government debt dynamics, which is kind of your how you think about fiscal dominance, but also by financial dominance. That are the consequences of monetary policy, tightening monetary policy, going to be so severe in terms of financial instability that policy is constrained in that regard. And I think the problem is probably, it's more acute in the euro area, just because by its very nature, it's a monetary union, but not a fiscal union. So you have to have a measure of what you may need to do is raise rates without widening spreads. Now, I think there are ways. I think there are ways to do that, but there are political constraints about how far you can go. Right. There may be constitutional constraints with German Constitutional Court, but that's the way I think about, about degrees of freedom. The degrees of freedom are coming not because the tools have been exhausted, but because you're reversing the direction of the tools.
Yeah, that's really well said. And I think it's a great way to break down kind of the etymology of that term. Shifting next, I think we have to talk about something that's been in the news all over. It's the Euro-USD parity. And broadly speaking, do you think this is more of a reflection of the frailty of the euro or the strength of the dollar? And I guess, break down, how we even came to this situation in the first place.
Well, I mean, I think right now it's very clearly a broad dollar story. The dollar is strong against absolutely everything. And what's interesting, this is kind of where the history part becomes really fascinating, and I'm going to go off on this because this is a kind of a very dear subject to me. Mm-hmm. Is that the dollar right now is being supported, I think, by three things. One is you have, a recovery in the U.S. that's more advanced than in other places, and inflation is more broad-based. There's a more broad-based inflationary dynamic in the U.S. economy, but certainly that in the Eurozone, where it's being driven to a much greater degree by energy prices, which then translates into a more hawkish Fed. So a broader based recovery, a more hawkish Fed. The second thing that's happened is that this is a huge distinction between the world before 2014 and the world after 2014 is the shale revolution, which in turn means that this is the first time really since the end of Bretton Woods in 1971 when you've had oil prices go up without blowing out the US petroleum deficit, right? Because if you think about what happened in the 1970s and again between 2002 and 2008, when oil prices went up, it was coincided with and led to a blowing out of the US trade deficit, and specifically of the energy component of the US trade deficit.
Yeah. Mm-hmm.
Which in turn, and in the context, especially of a Fed that was targeting headline inflation, core inflation, not headline inflation, you had kind of dollars flowing overseas. Other people are concerned, oh my God, these dollars are not going to be worth as much because rates are too low. The dollar is weakening. Right. I need to go and put my dollar somewhere else. Between 2002 and 2008, a lot of it was in euros. It was not a commodity currency, so on and so forth. So that dynamic has not been repeated. And this is really important because compared with both the Euro area and Japan, this is the first time you've had an oil blowout that has translated into a significantly worse deterioration in Eurozone and Japanese trade balances than in the US balance. So I think that's kind of turbocharged. That's turbocharged the dollar in this regard. Now, in those circumstances, if you also have, other things, I think a couple of other issues have come in. One is China and where we are with COVID zero, the impact. We're going to get some numbers tonight, find out how bad the impact was on Q2 growth, and in the Eurozone in particular, you have a situation where it's not just that energy prices have exploded, the energy prices have started to come down, but European gas prices are on the moon. Yeah. Right? Because so Brent is back to where it was. Brent is back below $100, but European gas prices are on the roof. So that's like a massive. It's a huge shock. It's a very large shock to potentially a very large shock to demand and a shock to inflation. So in the face of all these things, the dollar is exceptionally strong. What's surprising about this, given the nature of the shock in the euro area in particular, the trade weighted euro is still very strong. Euro sterling has not dropped below the 83 level that it went to pretty much a month after right after the referendum in 2016. Yeah. We've not taken out that 83 area. Euro yen is essentially stable. It's actually been a reasonably good carry trade for the last 2 years, surprisingly enough. So you look at all these other crosses, and the trade weighted euro actually looks okay. So I think this is very much a dollar story. The other point I would make here is that unlike the last time you had a the euro was this low, which is actually in 2002. The euro never got this low, even during the Eurozone crisis in 2011, 2012. The structural integrity of the Eurozone, I would maintain, and some people will probably challenge me on this, the structural integrity of the Eurozone is much less in question. There's some stresses in it. You've seen some pressure in intra-Eurozone spreads, but in a change, the ECB believes it is its responsibility not to allow these to blow out too much. BTP yields were 7% in 2011, now they're 3%.
Yeah.
And that's in the 10-year. The other thing I always tell people to watch out for is the place that captures redenomination risk on the curve is not the 10-year sector of the Bund BTP spread, it's the 2-year sector. Mm-hmm. And that's basically been just fine. So this is mostly a dollar, for all the headlines about parity. This is a dollar move.
But speaking of the demand shocks that we're seeing, do you think that this cheapness of the euro might ease the upcoming economic slowdown because of a potential likely spike in demand? And might we see something similar with other weak currencies like the yen unfold?
No. I think this is again something that I have I have a bone to pick, because in a world with insufficient demand, it's possible that a weak currency is good for you if you do not have, if you're not, like one of the ways to define emerging market is, an emerging market is a place where the structure of your national balance sheet, the structure of your asset liability mix, basically, the structure of your inflation dynamics, the structure of your capital account, all those things together mean that a weaker exchange rate eases financial conditions and does not tighten them. Right, so a developed market is a place that can get away handily with allowing its currency to depreciate by cutting interest rates and allow its currency to depreciate in a slowdown. And I think that analysis works a lot of the time, but it works especially strongly for developed markets when the world is short of aggregate demand. Mm-hmm. And if you have a sufficiently complex export sector, and you don't have high pass-through into actual inflation or into expectations, you get to export your way and steal demand from the rest of the world in a sense, or to, as some people would put it, by weakening your currency in these circumstances. It's not clear to me that those same conditions apply when you're confronted, or that they apply to the same degree when you're confronted with a negative global supply shock. And that's something that we've not seen in a long time, right? We're kind of used to this model that comes out of being in a demand shortfall that goes back at least to 1998, to the Asian response to the Asian financial crisis. Now we're facing something that's new and different, and the actual channels through which a weak currency helps you seem to have diminished, because you're potentially seeing much more an exacerbation of a squeeze in input costs, because you have a commodity price shock and a currency shock that's coming at the same time that may squeeze real incomes, that may squeeze sentiment. And there may be some signs of this happening in Japan. One of the interesting things that I've seen is that even Mr. Kuroda, he talked about the benefits of a weak yen coming primarily from the translation effect of a weak yen on Japanese earnings, then hoping that they would be recycled back into higher wages.
Yeah.
But there doesn't seem to be that much sign of, I'm not sure. There's some limited sign of that. It's not clear to me if that's going to, if that's going to persist. So, I think this current episode has me asking some questions about it's kind of unavoidable that, when faced with something that's both a growth shock and in terms of trade shock, currencies will weaken. The question is whether those developments are positive, even in developed markets, to the extent that we believed under conditions of a shortfall of global demand. And I'm not sure they are. One other point I'd make here from the point is about Japan in particular. This is a country that's been running inflation levels below the rest of the world for 30 years and counting.
Yeah.
Which means that on a relative disinflation basis, it has already achieved a massive cumulative real depreciation, right? Because your relative disinflation over 30 years, it adds up.
Right.
For that currency to undergo further nominal depreciation at a time when this country is the world's largest external creditor, 70% of GDP, the tune of like 70 to 75% of GDP. Whatever you think about, terms of trade and, internal balance needs a weaker yen, blah, blah, blah. From the point of view of Japanese external balance, I think there is zero excuse for the world's largest external creditor to have its currency be the weakest in real trade weighted terms that it's ever been.
Yeah.
And it may put additional pressure on other countries that are competitors with it in the region that may have, somewhat different problems. The yen-Korea exchange rate the yen is now so weak, even with the weak Korean won. The Korean won is strong against the Japanese yen. I'd argue that, the Koreans don't really need that. One of my polemical way of putting on this on Twitter is the Bank of Japan behaving as a responsible international stakeholder in the global monetary system? My answer is no.
Yeah, I think it's really important to draw that distinction of, comparing different periods of time, because, the demand shocks and supply shocks that we're undergoing right now are really kind of unparalleled. And, we have to take different time periods, like with a bit of a grain of salt, I guess. When we're about to wrap this up, we have a final question from Mayank, who wants to know, why do you do so many puns?
One thing the first answer is because I can. I did not actually prepare a pun answer to this. I will also say that not only because I can, but because I have an audience that will not come beat me up or groan, because it's on Twitter, it's on social media. That's where I make that. My family thanks my Twitter following for sparing them, what might otherwise be uncontrollable. So, Mayank, you're falling on the grenade for my family, and I thank you for that.
He's a soldier, and we all appreciate him for that. Great stuff today, Karthik. Really appreciate the time, the insights. Thanks so much.
It was a pleasure being on. Thanks so much for having me.